Today's podcast is brought to you courtesy of our friends at Tuttle Capital, who not only create defiant ETFs for the market, but help investors choose better, navigate smarter, and rest easier. Tuttle Capital, the antidote to Wall Street.
All right, joining me is Robbie Mitchnick, Global Head of Digital Assets at BlackRock, who of course is the world's largest asset manager, nearly $13 trillion in assets under management. And in the ETF space specifically, they're the largest ETF issuer, about $3.8 trillion here in the US. That of course includes the two most popular spot crypto exchange traded products, the iShares Bitcoin Trust, ticker IBIT, and the iShares Ethereum Trust, ticker ETHA. And I would say BlackRock has some other initiatives potentially cooking in the crypto sphere as well, which we'll get into. Robbie, it's a pleasure. Welcome to the podcast.
Yeah, thank you, Nate. Always good to see you.
And by the way, in addition to the various accolades I just mentioned at the top, I believe you're the world's largest digital asset manager as well, right? With IBIT and ETHA?
Yep, that's correct.
So, what's amazing is that you have accomplished this in 20 months or so, actually a little bit less than that. I'm just curious, what's the ride been like for you being directly involved here?
Well, it's been quite a journey, as you can imagine. Obviously, I joined BlackRock in 2018, so it's been 7 years now in this capacity, and certainly the last two have been the most interesting of a journey that's been interesting and exciting throughout, as digital assets has become this more mainstream topic, and we as a firm have become deeper and deeper into it in providing solutions for clients. So the last two, obviously, we launched IBIT in January of 2024. I think everyone here had pretty strong expectations for what that could be, but not quite to the extraordinary levels that it ultimately has proven to be in terms of client demand across the segments, really, and investors, direct, wealth advisory, institutional, even large existing Bitcoin holders. And so executing on that, being a part of that growth, having many different teams across BlackRock leaned in and fully dialed in around this, and making sure that first that we built the product in the most optimal and robust way that we could, and that now we continue to operate in that way while maximizing the client opportunity and being a real thought partner and educator for clients as they come into this space, and having added Ethereum later that year. That continues to sort of round out our offering and adds another dimension to those conversations that we're having.
Yeah, it's amazing with IBIT. I'm not sure I have any more superlatives for this ETF. I mean, it launched in early January 2024. It's over $85 billion in assets. It's already in the top 25 of assets out of about 4,500 ETFs. So that success is remarkable. And to your point, the iShares Ethereum ETF, that's not too shabby itself. It launched in July of last year. It's already around $16 billion in assets. It is easily the top ETF launch over this time period. That's out of over 1,000 new ETFs. And actually, it's also one of the most successful ETF launches ever. What's been your impression with ETHA? Were you surprised at all with that, or did that make sense after what we saw with IBIT?
Yeah, well, it's funny, to your point, for a while there, even as ETHA was doing very well for a new ETF launch, there was sort of this narrative in the crypto community that the Ether ETFs were a bust because they were being compared against the extraordinary record-setting numbers of their Bitcoin siblings. And today we sit here, ETHA around 15 billion. It's actually the third fastest ETF in history to reach 10 billion. Of course, much more slowly than did IBIT get there, which was 7 weeks, but tremendously successful in its own right. I think that we knew obviously, Ethereum today, it's 500 billion market cap asset. Bitcoin is over 2 trillion. Bitcoin has a lot of benefits in terms of investor education and thinking about the investment thesis and how it fits in a portfolio. A lot of investors thinking about it as this sort of digital gold type instrument, which really resonates, particularly in the current global and macro environment that we're in. Ethereum is a more nuanced, more technical discussion, really a bet around blockchain adoption and digital assets more broadly. Of course, Ethereum has lots of competitors, which is a little bit different than Bitcoin, which is sort of resoundingly won its niche as this digital gold sort of store of value, emerging monetary instrument. And so there really are different stories. I think increasingly as this market becomes more mature, you'll see a much starker decoupling in the way these things trade and the way people think about them as investment assets. To date, people have sort of lumped everything together as crypto, and Bitcoin has been sort of the least volatile and sort of most tightly bound in terms of upside and downside, even as it's held this incredibly strong market share, around 60% of the total market cap over the years. And they've sort of ridden together in terms of adoption trends and acceptability and political and regulatory dynamics. But once we get past that, I think a lot of those early hurdles have now been passed. It's going to come down to actually the investment theses and the properties of them. And that's where Bitcoin and ETH are actually very different.
Well, talk more about that. I'm curious how BlackRock is seeing both of those used in client portfolios right now, because again, there are some real differences here. I think the narrative around Bitcoin being digital gold, I think a lot of investors can get their head around that. And some would put that in, say, the alternative asset category in a portfolio. I think with ETHA, there's a little bit more debate around where that resides. Is that an alternative asset? Does it go in the equity sleeve? We don't have to go into great detail here, but I'm just curious how BlackRock is seeing clients utilize both of those within the context of a broader portfolio.
Sure. Well, the first thing I'll say is that for institutional and wealth advisory portfolios, there is much greater penetration of Bitcoin than there is of Ether today. So as we noted, Ether's done extremely well. It's 15 billion in assets today. That is still overwhelmingly end investors direct, whereas Bitcoin sort of started there, but in the ensuing quarters, we've seen steadily a growing presence of wealth advisory and institutional that has certainly surpassed what the level of focus is, I would say, on Ether or any other crypto asset from those client segments. And that's because of the things that you alluded to, Nate, of how that clarity of investor thesis and how they think about it as in the portfolio as a unique diversifier, as a potential hedge, similar to the way that investors have often used gold over the years. So with Ether, it's different because it is really a bet on a particular technology theme. And so that, when you think about what does it replace in the portfolio, what is it most similar to, tends to look more like tech equities or even, venture capital type bets. And so it is getting treated in different ways. Of course, with Ethereum, as I mentioned, the fact that there's a lot of different competitors, Ethereum has built a really credible network and scale advantage that has some moat value, clearly. It's more than 3x larger than its largest competitor by market cap, but there's a lot more nuance to that discussion and thinking about the investment thesis, not only from a perspective of how much do you believe in the adoption of blockchains, of digital assets and things like tokenization, stablecoins, DeFi, et cetera, but how do you view the dynamics playing out between these competing blockchains, L1s versus L2s, and the actual value capture in, say, the Ether token versus the activity level on the Ethereum blockchain. So there's a lot there. And obviously we've been, very happy to be in a position to be a measured thought partner for many of our clients as they try to get educated on this space.
In terms of potential demand moving forward for both IBIT in ETHA. And I'm not expecting you to put actual numbers around this, but I'll just say I still believe we're very early in the adoption of both Bitcoin and Ether ETFs for a lot of the reasons that you just pointed to. And I would say there are still a lot of advisors who can't even access these products yet, right? There's still some gatekeeping around them. I think there's another subset of advisors that are still learning. They're still conducting due diligence. And I would say there's certainly a big segment of retail still getting comfortable here. And so just at a high level, what type of demand do you expect moving forward? Because both of these ETFs, they put up historic numbers. So can that continue?
Well, you're absolutely right that this is still early days. I think for the end investor segment, it's probably a little bit further along. That penetration came right out of the gate and has been pretty substantial. But when we talk about institutional and wealth advisory, you're completely right that it's very early. And the reason is from a wealth perspective, as you noted, a lot of advisors, in fact, the vast majority of advisors in the US today still do not have the ability to make decisions on this on behalf of their clients. So all of these firms have approved it from an execution only perspective, but the client has to be the initiator of it. That's generally not how the wealth advisory model works. And so the largest wealth firms in the country are at various stages of approving this or doing their due diligence with the intent to eventually support this for their advisors being able to actually make portfolio decisions around them. And so there's a few at the leading edge that have crossed that bridge now. There's one actually that started to put it in model portfolios, which is a significant development. Our BlackRock model portfolio teams, they early in 2025 for the first time put IBIT allocations into one of our model portfolios as well. But as you noted, still early days there. And on the institutional side, I think what a lot of institutions are working through is how to think about this from an investment, return, risk, portfolio modeling, impact, et cetera perspective. You have the attributes of Bitcoin, which point very decisively, I think, a certain way where this is a global, scarce, decentralized, non-sovereign asset that has a distinct set of risk and return drivers from most traditional assets, and in fact exists outside of the specific economic, country, political, fiscal, monetary, et cetera, risk factors of any one country. That points in a certain direction, but then it has certain points and periods where the trading behavior doesn't look consistent with that. And that mystifies, in some sense, a lot of institutional allocators as they think about how to perceive this. And so that's a place where we've been doing a lot of education and been a thought partner to our clients. But I think that there's probably one or two more episodes where you see Bitcoin decoupling from equities in a sort of distressed market environment for equities is going to be critical to driving that point home.
Before we move on to some other topics, in terms of demand for ETHA specifically, it's been well documented, but spot Ether ETFs have put up these impressive numbers without the ability to offer staking, right? Investors are missing out on that staking yield or staking reward. Do you think that's impacted demand at all? And can you tell us anything about the status of that in terms of the SEC?
Yeah, so at the margin, surely it's probably had some impact on demand. The ETP wrapper has proven to be an extraordinarily effective, compelling vehicle for many types of investors for holding Bitcoin in a way that is slightly less optimized in the context of Ether because you have that staking dynamic. Obviously, these products have still been very, very successful in spite of that. But if there's the potential to add that in a way that would obviously benefit investors, assuming it can be done the right way, that's probably a further incremental lift to where the demand would come from. And we're encouraged to see some of the progress there, and that hope that ultimately that gets over the line sometime in the not too distant future.
And is that really more of an issue of figuring out the taxation of staking rewards within the ETP, or is it still with the SEC? Is it both?
Right. So it's not a super straightforward problem, I would say. It's not like there's just some bureaucratic process that needs to be worked through. There are some complex issues. There are tax questions to clarify around this being viable in the grantor trust structure, which is what the legal structure of all of these 33 Act ETPs for Bitcoin and Ether are, that indeed, as we believe, staking is compatible with that structure, as well as from a liquidity perspective. Obviously, ETPs by definition are meant to be very liquid vehicles. Staked Ether is not fully liquid. Obviously, there is an exit queue, an unbonding period that is required to get from staked ETH to unstaked Ether that can then be freely sold. So those are the sorts of issues that are being worked through.
Sort of on the topic of the SEC and what they may or may not allow, I'm sure you saw that they recently approved generic listing standards for commodity-based exchange-traded products, which, of course, that would include spot crypto ETFs. Any thoughts you can offer here? Does this framework make sense to you? Do you expect it to further evolve? What, if anything, can you offer on this?
Yeah, I think we view that as a pragmatic step to streamlining the process and supporting innovation in this space, laying out standards that are clear and transparent, and that makes it easier for issuers as they think about innovating and new product development in this space. So I think it's a positive.
In terms of product development, let me ask you this, and you don't have to comment on the first part. And actually, I don't expect you to comment on
that
the
probably
on the first
won't
part.
then if you're prefacing it like that.
All right, so I have actually publicly predicted that BlackRock would file for a spot XRP ETF and a spot Solana ETF, which you have not yet done. And again, I'm not expecting you to comment on that at all. But what I will ask you is, how is BlackRock thinking about future product development around crypto-related ETFs? Because you have had these two massive success stories with IBIT and ETHA. So certainly that has to have your attention. But what about moving forward?
Yeah, well, there's a lot of factors that go into that decision-making process, obviously. But the biggest driver ultimately is our clients, right? What is the level of investor demand? What is the logic and investment thesis for investors and for our clients around these potential products? What problem are we solving for them? And so when we think about other potential opportunities in this space, obviously we're looking at things like market cap, liquidity, maturity, but also clarity of investment thesis and overall sort of product and portfolio considerations in terms of how clients long-term are going to be able to use products in this space, build the types of portfolio exposures holistically that they want. And so that's a constant evaluation process. It's not a fixed point in time thing, but ultimately that's the kind of process that we deploy.
All right, if we move beyond crypto-related ETFs, I want to ask you about this recent report that BlackRock is considering or evaluating ways to tokenize ETFs. So I think, as you know, this has been a hot topic in general. And Robbie, I've actually stated multiple times on this podcast that I do believe we're heading towards a world where all securities will ultimately be tokenized. Now, even if you can't comment directly on that report, which I certainly appreciate, I would love to hear your thoughts on the tokenization of ETFs overall. Like, would you agree that this is ultimately where we're heading?
It certainly may be. I think that tokenization is pretty early in its journey. Obviously, the adoption has been somewhat limited to date across the, let's say, 7 or 8 years that various projects have been working on tokenizing kind of all manner of assets. So far, the one place where you have clear product market fit is in money market funds, because what tokenization in concert with stablecoins has made possible is the breaking of this trade-off that you historically had to make between having full access to yield on your dollar savings and having full liquidity. And now with tokenized money market funds that become 24/7 instantly convertible back into stablecoins, you can generate full yield on your savings. And the moment you need digital cash to settle a transaction, make a payment, etc., you're able to do that. So that's a really powerful unlock. I think a lot of other asset classes, we're still looking for those critical unlocks, those critical solutions to longstanding problems that the more general tokenization value prop of being global, liquid, 24/7, instantaneously settlable, transparent, programmable, etc., how you apply that general framework to solving real problems and unlocking utility for market participants in kind of the vein that the tokenized money market funds have. And so we're looking at lots of asset classes to try to figure out where the next big opportunities are.
So if I'm hearing you correctly, it sounds like you're certainly a believer in not just tokenizing to tokenize. Is that fair?
That's right. I think that a lot of projects in the early years have gone sort of wayward because they merely relied on that high level value prop of all those attributes that I mentioned without really drilling down into what's the specific problem for users or for investors or for issuers that's being solved in a significant step change or 10x better way.
Just a few minutes left here. You mentioned stable coins, which perhaps this is somewhat related to securities tokenization as well. I feel like there has been a lot of buzz around stable coins lately. We obviously had the Genius Act passed several months ago, that stablecoin legislation. It does look like there are a number of players in the financial world who are looking at this market. I'm just curious, how is BlackRock thinking about stablecoins?
Sure. Well, we've been a big believer in this for a long time. We first started managing reserves for Circle and USDC in 2021, made a big investment in them in 2022 and have a longstanding partnership there. So we're excited about the potential for stablecoins. Today, stablecoins are primarily used just within the crypto exchange trading and DeFi ecosystem. We think the potential for stablecoins to go well beyond that, particularly for cross-border payments, whether you're talking about retail remittance type activity or corporate multinational cross-border payments, as well as their penetration into financial markets to be able to be used as settlement assets, subscriptions, redemptions, corporate actions, life cycle events, etc. All these places where cash moves today that stablecoins may be able to solve those use cases more efficiently. So we have been and continue to be big believers in that. And the Genius Act, I think, is going to be a great catalyst for some of that more mainstream and traditional finance adoption.
Well, Robbie, I greatly appreciate the time this week. Congratulations on all the success you're having in the digital asset space. Certainly wish you continued success moving forward. Thank you for joining me.
Thank you, Nate. This was fun.
That was Robbie Mitchnick, Global Head of Digital Assets at BlackRock. Hope you enjoyed this episode of Crypto Prime. I want to thank our sponsor, Tuttle Capital. If you would like to learn more about Tuttle Capital's ETF lineup, you can visit TuttleCap.com. For exclusive daily market insights and the playbook that Wall Street doesn't want you to see, subscribe to Tuttle's free newsletter at theheatformula.beehive.com/subscribe. See you again next week.
Crypto Prime is hosted by Nate Geraci, president of OTR Media LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. Some guests appearing on this program may also be financial sponsors of Crypto Prime. This program is for informational purposes only and does not constitute investment advice. Investing in crypto assets involves substantial risk, including the possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Visit CryptoPrimePodcast.com for more information.